Sunil, were the markets really factoring in this level of escalation? Because till now we were looking past, the retaliatory action by India, which is non-escalatory in nature. We were expecting some bit of retaliation from Pakistan, but were we really expecting or factoring in, this kind of escalation?
I think as a defense forces, I think so because they whatever the attacks Pakistan have tried against us, we have repelled them, and I think we've been proactive. So I think from a defense, while the nation itself maybe would not have been expecting that, but I think the defense establishment clearly has been on their guard, and that's clear because we have repelled every single one of those attacks. So I think from the military perspective, right, I think they've realized that since we have hit the nerve center of what they were supporting, they were expecting a kind of reaction from them and they were prepared. So I think, but probably as a nation, as a market, as a public, we are probably taken by surprise because we thought that just like Balakot and Uri, that Pakistan would just not react to this. But clearly, the damage has been far worse there for them to then react.
Sure. In terms of the market, really, I think, as I've been saying, it would be more about sentiment rather than levels because, a knee-jerk reaction is expected because in the pre-open, I can see the Nifty is down somewhere around 340 points or thereabouts, 23,930. That's where it's at. Do you think sentiment will take a hit in a big way? And would you expect a fair bit of panic selling today?
So I would say that there's a fight between India and Pakistan, but there's a fight in the market between a short-term hedge fund and a domestic trader versus a long-term investor. Because yes, I saw the data yesterday also. The net FII flows were 2,000 crores positive. So what is that? I think that there's been a massive amount of selling by short-term hedge funds and at the same time a compensatory buying by longer-term sovereign wealth funds and pension funds and insurance. And the reason for that is very simple, right? Because I think the hedge funds, if you see from April middle is when they started entering India with the crude price fall, with the dollar weakening and expectation of a US recession leading to an expectation of rate cuts, right? So that's made the sentiment positive. And I think a lot of them have entered over the last 3 to 4 weeks. Now a hedge fund typically varies from a week to maybe 3 months in terms of their call, right? So for them, when they see that they've already spent 15, 20 days in the market and then the next 15 days, the volatility will be there, some of them may be booking profits and taking out the money, which is very natural and which is what the fear and the greed. But at the same time, I see longer term investors stepping in to control that. So this is a balance now. So today, because of the escalation of yesterday, I expect that to continue. You will see intensified selling by shorter term investors. How far the longer term investors see and wait for a price correction before they re-enter, that's what is going to induce the volatility. So I expect the volatility to be sustained for some time. How far the market will fall today is essentially decided by these long-term players because they will be tracking individual stocks and sectors. And as we are aware, despite the fall, the large cap index is still around about the long-term valuation. It's still not coming to cheap value territory. So they will be looking at specific stocks and sectors, and if they come down, they will step in to buy. But at what that point is obviously spread over a large number of stocks and sectors. So we'll have to wait and watch.
Okay, wait and watch. That's the approach. Hold that thought, Sunil. We also have Raja Venkatraman, co-founder of Neo Trader, joining in. Raja, great to have you joining us this morning. Important morning. Of course, we are awaiting the market open. In the pre-open, we are seeing a 350 point cut. Although it will be more about sentiment and less about levels today. But if I were to ask you to pinpoint a support level on the index, what level on the downside would you look at for today?
Yeah, good morning, Nandita. Very rightly said and very aptly said that right now the levels are not so much of importance compared to the sentiment. But then when you take a look at the entire market scenario that has been unfolding over the last few days, there has been a clear hesitation at the higher levels, and that's what is prompting this reaction at the moment. And lower levels will continue to be bought into because our market is much more stronger and resilient. So the dips are to be considered as an opportunity to buy into. But then, like the earlier guest, we got to wait and watch what really happens today. So I would take a closer look at around 23,600 to 23,700 as an important support zones. And I'll be tracking the
Hmm.
Nifty spot because that's where the whole tracking I do. And I find that around that zone, it's a
Hmm.
very good buying area. But I look at that if the market dips and if it comes into that area, then it will be a good area to buy into. But then looking at the kind of excessive selling sentiment which is there right now, I think that it will be a flash dip,
Hmm.
and then the markets will tend to consolidate at the moment. So right at the open, the markets are opening gap down, but then I would wait for the first half an hour for the market to settle down to take any course of action.
Okay, first half an hour of market action will be crucial. On that note, the first ticks are coming in. It is a 200-point fall. Last evening the GIFT Nifty was down 500 points, so it's not that magnitude of a fall, but it is a 200-point fall on the Nifty. We are defending the 24,000 level as of now, but we'll have to see how much of a panic selling we end up seeing, because we have the briefing from Defense Ministry as well slated later in the day, sometime soon, so to say, shortly. So a lot of cues will be coming out from there as well, but we have still managed to recover from opening lows. We are now down just about 140 points. We fell somewhere around 140 points yesterday, although we came off 250 points from the day's high, and right now we have managed to cut some of those opening losses and are down somewhere around 150 points. The mid cap index, a measured fall there as well. It's a 0.7% kind of a fall there. Yesterday, the magnitude of fall on the mid cap index was more pronounced. We saw a 2% cut on the Nifty mid cap index. But yes, weak start, but not as weak as one would have anticipated. Advanced decline ratio is extremely poor. Early days to actually call it a trend, but 1:13. That's the Nifty advanced decline ratio. 127 advances to 1700 declines. I want to see in terms of the rest of the market how things are really panning out when you look at the sectoral action. Yesterday, most of the sectors ended in the red, barring the IT pack, I think, that managed to hold on. But of course, today the weakness is broad based. So I'm guessing, all the sectors in fact are trading in the red. But the cuts aren't all that deep. If you see the sectoral laggards, they've all lost some around 0.8% to 1%. It's not like a 3-4% cut on any of the sectors. Only the realty pack is down 1.5% or so. In terms of the Nifty movers, there are only 3 or 4 gainers, so to say. One is Tata Motors. In the wake of the US-UK trade deal announcement, it was supposed to gain any which ways, and it has been on a gaining trajectory as well over the last couple of sessions. Bharat Electronics from the defense pack, standing out as a gainer. L&T, good outlook. It reported its numbers yesterday. The stock is up 3.5%. The guidance has been good, and the stock is reacting to that. Titan as well came out with its numbers, and it's reacting to that. So a very slim list of gainers at the current juncture. And looking at the laggards, just want to point out a few movers. Power Grid, Eternal, Adani Ports, Geo Financial, Coal India, Asian Paints. These are some of the laggards. So all in all, yes, it is a weak start, but at this current juncture, the fall is looking a bit measured. Sunil, what should be the capital protection strategy right now? More than logic, there's a lot of emotions at play, and a knee-jerk reaction is to sell out and raise cash and sit on cash. Should that be the capital protection strategy now?
Not really. I would say that if you now look at it from a existing investor perspective who has fully invested in the market, right, versus somebody who has kept some cash on the sidelines, I would say two different setups. So somebody is fully invested in the market. If you want to take out some money from the market, right, it's not a really good day to do that, right? So I would say that you hang in there. You just control your emotions to avoid panicky selling, right? Unless, of course, you have a need for the money, which means you're taking the money out of the market. I leave that out of the side. But if you're sitting on some amount of cash, I know there have been a lot of investors, domestic fund managers, for example, are sitting on over $200,000 of cash. So I would say that's the money where your best strategy is to deploy a small proportion of your capital. As an individual, I would say 1% of your free cash, right? Put it in, but hang around quality, hang around larger companies, right? With this frame in mind, that's the best capital protection because these are the companies which will not fall that much, but because of the nature of the volatility, there will be it's a good price point to buy into, and which they will also bounce back. Whereas anything falling very deeply may take a bit of time to come back up the top. So I would say deploy a small proportion for an individual investor, probably 1% of their free cash, but consistently deploy it every day a little bit, but stick to the quality as a paradigm and ipso facto larger companies. I'm not saying large cap necessarily, larger companies even within the mid cap space as your best defensive strategy, if you so call it. But you will still be participating in buying good quality at a cheaper price than you got them a few days ago.
Sunil, would you like to take us through which pockets one should look at? I know we've been having these conversations on a daily basis, but for the benefit of our viewers, if today was the day to deploy some cash, which are the pockets they should look at?
So I would say two major factors which are driving this, right, nothing to do with the war, are the oil price drop and a positive RBI rate cut outlook. If you keep these 2 points into mind, clearly BFSI stands out as a beneficiary, and consumer discretionary stands out as a beneficiary. So I would say that because consumer discretionary stocks also tend to benefit from the import prices of crude related derivatives coming down, and at the same time, the budget giveaway on the tax would mean that there could be some amount of positive buying happening in terms of the high-end durable segment. So I would say stick to BFSI as well as to consumer discretionary or buy a broader consumption fund, I would say, because FMCG will come into a fund, but maybe from that point of view, from a growth perspective, FMCG may not be, but defensive wise it will help you. So that's my best way is probably rather than go and pick individual stocks at this point in time, pick a good financial services fund and pick a good consumption fund. That's the better way to play this because both of them are not related to the war too. So the temptation to go and buy defense in time of a war, right, is a sentimental thing. I'm not sure it's yet fundamentally supported.
Yeah.
So I would say stay away from that because you're just going to see a bounce back on defense, but it's probably not fundamentally something that you should look at right now.
Okay, fundamentally you should not look at defense right now because that will only be in knee-jerk reaction to what's unfolding across the border. But technically, Raja, what do you look at? Do you look at defense technically at least?
Technically, defense has been playing around quite well, and over the last few days, the defense sector has been showing some promise. And amongst them, as a trading bet, yes, you can look at HAL compared to BEL, though BEL has a positive news. Yes, as a trading bet, HAL definitely looks well on the charts. And over the last few sessions, they have been holding on to the higher levels above 4,000. And it looks like it's poised for more upside. So even today, it began the day well, and I think that it has potential to cross 4,600 by the end of the month. So it's a good play for a multi-day play.
Okay. All right, that's the word. But, coming to you, Sunil, on the FII sentiment, I know you alluded to it briefly, but, FIIs have already covered a lot of short in the system. In fact, they were going long. Any risk of long unwinding when it comes to FI positions in index futures now? Because as I mentioned at the start as well, the focus was more on the trade side. But with this escalation, yesterday the news came a bit late in the day. So 15 straight sessions of pumping in money in the Indian market, and $5 billion worth of of funds invested in India in the matter of a fortnight. But any risk of that reversing, at least till the situation stabilizes here on? So
I would say is that if you look at it for me, it's the interplay between a short-term FII and a longer-term FII. So I do think that if the war situation continues for some time, there would be a temptation for the short-term hedge funds to book profits, right? But at the same time, I expect the longer-term sovereign wealth funds to continue to look at bargain picks within their space, right? And that's why for me BFSI, when I mentioned, is because 35% of the large cap index is BFSI. So that's where then they would tend to buy. But to predict that when these longs will get unwound, right? So the from a hedge fund perspective, right? It depends on, see, what I'll tell you what's the issue, right? We are looking at the Indian media, and obviously the coverage is India oriented. But internationally, Pakistan is doing a lot of misinformation. They're claiming to have shot down
Yes,
Rafale.
that's
They're saying
correct.
India attacked ourselves. So to a foreigner, he's looking at and he's trying to look at BBC, look at Sky
It's a
News,
war of
look at.
misinformation as well, it looks like.
Correct. So, to a short-term hedge fund manager, to the extent he says, "Oh, if I assume even 10% of misinformation is true, is that something that India is hiding?" So there will be a negative nurse reaction, and somebody who says, "I'm in the money today, and I in 1 week later I may be out of the money, so might book profits." Is a very, it's not sentimental. It's a very tactical call saying, "I took a short-term call. I have made money. Now, do I get out and book my profits? I can re-enter later." So I'm saying that kind of volatility will be there, and one must be prepared for that. So the net numbers is what we see, right? We don't know how much long, how many long only FI, long-term FIs have come in, how many short-term have gone in. So this balance between the two, right? I think is that. But that being said, right, like I said, what is the worst case scenario? Or why would even a short term want to book profits, right? It's if he's trying to guess the other short term players' intentions. You get my point? It's not about any damage to India or to the financials or to anything. It's about saying, oh, if there's going to be a domino effect on other hedge fund managers selling, then let me go in before they sell and book my profits. So it's more about trying to outthink the other short-term players in the market, and that's a constant thing. That's one. Second is the algorithmic traders. They tend to feed in certain key variables into the picture, right? So the one of the key things which probably they will look at is, because of this or war-related spending, right? Is India's fisc going to be under any stress? Because we have clearly indicated path of an improving fiscal deficit. Now, because of this war, are we going to have to rejig the budgetary allocations? So it's something they will factor in. If they put a probability to that, then those numbers will change and some algorithmic selling may happen. So these are all unpredictables, but I'm just saying that one has to be prepared that while we look at medium term India as positive, not every person there is looking at it as entirely positive, because they have come in at certain levels with certain expectations and they have certain short term outlooks. So within their horizon of time, if there is something which is going to, volatility going to sustain, somebody will take profits off the table. So it's a part of the normal healthy market. And from a longer term investor perspective, I think this is a wonderful opportunity to buy small bits. Keep nibbling at the good quality stocks is, I think, your best ever protection that you can do.
Any thoughts on the money markets, Sunil? Rupee, as I was mentioning yesterday, saw its biggest single-day drop in 3 years. Yields also spiked. What are the major concerns emerging when it comes to the money markets as a result of this conflict, escalating conflict?
So I think that impact is essentially dependent on the RBI. As far as I was aware, the strengthening of the rupee a few days before, RBI was not so happy with it. So my sense is that this rupee's weakening is something RBI is allowing to happen. See, and so I don't think that they will go and defend the fall. And when they defend the fall is where they suck liquidity out of the domestic money markets. So I see that from an export perspective, RBI was not very happy. It's my own read of it, with the strengthening of the rupee, right? Because when we are trying to increase our exports and build a case, the strengthening was not really. So from that point of view, any depreciation that's happening, and why is this happening, is because of covering by the traders, because FI flow is still net positive. So you can't say that FIs pulling out money caused this weakening, right? Because the net number of FI was positive. So from that point of view, I would say that RBI will allow a certain level of healthy depreciation. So only when the rupee falls to a level where they feel the need to defend it, will you have an impact on our money market, because that will mean they will suck out liquidity from the market to buy the dollars, right? So it's not yet at that stage, but you have to keep watching and observing this situation. So it's RBI which is essentially going to decide the money market's whole situation and fate on what happens then.